Hello, everyone, and welcome to our K-1 Pass-Through Entity Series. I'm Dave Stauffacher, the Senior Chief Credit Trading Officer here with the Lenders Online Training, where we help lending and credit professionals say yes to good loans. Linda Keith, our company's founder and Chief Credit Training Officer. I actually said I was the Chief Credit Trainer. Oops, almost. Sorry, Linda. Linda, forgive me.
I'll share. You can choose.
Linda, first of all, it's a pleasure to be with you today. Thank you for joining me. How you doing?
Happy to be here.
All right, Linda, as you know that we get questions from hundreds of people during our sessions here, and our K-1 series has been very successful. A lot of people ask questions. Why? Because this is kind of confusing at times, and they're looking for some key insight we'd like to deliver. So a question that came upon us today would have been, and this is a weird one, and I'm sorry about that if you were submitted this question, but what should I do if I don't get a K-1? Linda, what's weird about that?
So thank you, David, for thinking about the feelings of the person who asked this question. It's a great question. And frankly, it's not just one person who has this question. I got to tell you, I've heard this question a lot. What if we don't get our K-1s? What if we can't get the K-1s? What if they don't give us the K-1s? What if they say they don't know what we're even asking for? So I keep saying these, we're going to go for a short live stream, but regularly surprised. So let's just see if we can make this kind of short. My answer, if somebody says to me, what do I do if I can't get the K-1s? I would just say, ask again. Hello. If this is a requirement of yours, at least as a longtime borrower, I'm a real estate investor. I had my company. I was CFO of my husband's construction company. And truly, if a banker asked for something and I said, gee, I don't have it, or I gave them everything else but didn't give them that thing, they didn't not ask again or tell me again for that matter. Occasionally, I would actually say, I don't think you need that. The answer was Linda. Yes, I do. So ask again. Somebody has them. And so part of what I think the confusion is that borrowers, certainly the 1040 filers, they themselves don't think they got it because it's not in the 1040. So the tax return they then see doesn't have it. So everything else you're asking for, it's like they can find it. But this is like, I don't have that. Well, it's because it's part of the 1065 or the 1120S tax return, not part of the 1040. It is used just like if I get a 1099 Schedule B from my bank to tell me what interest income I got, and then I put that number on the 1040. I don't attach the bank's 1099 to the 1040. So this K-1 doesn't end up on the 1040. That's partly why I think sometimes there is some confusion. They did get it at some point. They just passed it on to their preparer who used it to prepare the 1065, 1120S, or the 1040. So that's partly where I think this confusion comes from, and where your borrower might say, I don't have it. And then the banker goes, oh, okay. No, we don't do that. So let me start with, if you are lending to the pass-through entity, if you're lending to the entity, it is a guideline issue whether you're going to require the K-1s for everybody to decide who guarantees. What percentage owner are the owners? Who do I want to use as guarantors? And if you have guarantors, you're going to do a global analysis. Now you got the 1040 return of those individuals, and you may need to know what distributions they took out. And I actually do have a wrinkle to that. And what I've discovered is if I don't mention the wrinkles when I think of them, then I don't remember them later. So let me go with this right now. Let's say you're doing a global analysis. So you're looking at this pass-through entity. You are looking at the guarantors, but you're not requiring every one of them to guarantee. What you need to do is count the distributions against the business, give credit to the distributions for the owners. Now, if you had everybody guaranteed, you just washed, right? Distributions out, distributions into everybody, it's a wash. But if you are not requiring everybody to guarantee, then you will lose the distributions made out to those non-guarantors if you don't subtract all the distributions from the company. But if you're subtracting all the distributions from the company, then to get your global to work, you need to add the distributions received by the guarantor. So it's a little bit of a side issue there, but it is important. when we're trying to make those distributions work out. So let me look back at my notes here. It is a guideline issue if you require entity returns of other entities owned by the guarantor, but not obligated on your loan. That's up to you. You could say, you know what, they're not obligated. All I want is the K-1 related to that. It also could matter whether you really need the guarantor to make this work. If you really are at a point where you say, you know what, we lend to an entity that stands on its own. And yes, I know it's our guideline to do a global analysis with guarantors, but truly, if it doesn't stand on its own, we're probably not going further. And therefore, we don't need the guarantor to give us entity tax returns of everything else they got. It's almost pro-formative that we're using the global, but we really are not counting on it. So let's see. That is if you're lending to the entity. And do we need the K-1s for that? Yeah, if you want to make your guarantor decisions. All right. So next we're going to talk about what if you're lending to
the owner.
So
if you're lending to the owner, okay, here we're going to bring up the issue that it's a guideline issue as well. Your organization wants to understand as far as, do you want to, based on your guidelines, do you want to skip some of the K-1s? Possibly. Do you want to get only the K-1s and not the returns based on percentage of ownership? Possibly. You want to get all entity returns if you want to play to the actual cash flow from the K-1. That's another guideline issue. So once again, it gets into the issue of depends. Maybe you realize that maybe the entity itself might be struggling. We want to know more of that because they are guaranteeing they're involved with that, or they're getting a lot of money from these other pass-through entities. We want to understand how that impacts their future cash flow. That's important. So in our training on our tax return analysis, and we actually have another live stream on that with regards to an issue of passive versus non-passive. Kind of a confusing term, is that right, Linda? I mean, if it's
IRS.
Yes, the IRS did again. So if it's passive, okay, let me think about that. Well, you're kind of an investor. If you're non-passive, you're kind of the business owner. You're active throughout you're probably controlling the checkbook. You're making management decisions. In other words, you're pretty much a key part of that operations in some type of capacity. Now, on our focus on that, if you are non-passive, we're going to want the K-1s because we want to understand how important your decisions are. You control the checkbook. Actually, as far as how that cash comes to you, we'd want to know that. If you're non-passive, we're probably going to ask you to guarantee in some capacity, if not all of the debt. So we're going to want to understand that as well. If you are a higher percentage owner, we often say that you basically own the checkbook. You can pay yourself what you want. You can make decisions what you want. And that impacts us as a lender if we're lending to you personally. If you're a low percentage owner, okay, you may not have the total control of the checkbook, depending on our percentage there. We've often talked that if it's a 25% or lower, we may consider that, okay, we don't have necessarily are concerned as much of that, unless if you are further than that, if you're over 25%, or in some cases, there's a little bit of a tweener. Linda will probably talk a little bit about that as to what would be important of getting that information. The one area that we didn't talk about is in the 1065s, what if it's a general partnership? What if you are a general partner? The reality is you are liable. You have unlimited liability on the organization as a whole. If you have two general partners together, you're responsible for the decisions and the capacity of decisions made by the other partner. So you're responsible for all debts. And that's enough to kind of make us all want to know more information on that. So was that short enough?
General partner, David. Never. No. And to piggyback on that, even a 10% owner who is a general partner is liable for it all. So if you are going to cut corners and maybe skip some K-1s, now that you've heard the explanation, that passive versus non-passive, our belief is don't skip the ones on the non-passive side. Those are your active business owners. They're more likely to have guaranteed debt. That's where your general partners are going to land up. Although actually, I suppose it's possible that you could have a general partner on the passive side because they're not active in the business, at which point that would be red flags all over the place.
Yes.
A general partner not active in the business, but 100% liable. Somebody needs to give them some advice. Maybe not you, but somebody. So K-1s, we actually do recommend that if you're doing an individual analysis, you do get the K-1s, but we do recognize that you may have a guideline that says, and I've seen this, if it's on the non-passive side, in fact, one of them I saw once, it said, if it's on the non-passive side and it's less than 10% of their AGI, in other words, they just try to give a guideline that said, if it's a small enough number and it's non-passive, so they're just an investor, probably haven't guaranteed anything. Okay. If they have 71 of those, okay. But if it's on the non-passive side, we would recommend you get them. So we're back to the question, which was, what should I do if I don't get any K-1s? Our first answer was ask for them. But really that second answer is understand if your guidelines allow you to skip any. And if you're the person who influences the guidelines at your financial institution, if I was going to go for skipping anything, it would be passive side, smaller numbers. Here's one of the problems to remind you of. The numbers on the back of E are just their share of taxable income. So you really can't say, oh, it's a small number, so it's not relevant. If you knew what debt that company had, it may not be a small cash obligation. But mostly we want to get them, understand when you're allowed to not get them, and on what basis maybe you should do it anyway. Right, David?
Yes. Awesome.
All righty. So that is it for today. We would love to have your questions, experts at lendersonlinetraining.com. We answer them. We do blog posts and we do these live streams from those. Also, if you'd like to get on our weekly subscription to emails, which is where we also post answers to those questions, lendersonlinetraining.com, Ask the Experts, comes out once a week. Subject line has the question, ignore it, pass it to your team, or read it as you wish. We see that and these live streams as sort of the drip method. We don't really consider it training. We consider adding it on top. It's like the cherry on top.
Yeah.
Yes. You need training. Your people need training. We're happy to do that. But this is that extra bit that will help you say yes to more good loans. And for those of you who are more experienced, to lead those junior folks to develop their skills so that they also can say yes to good loans. That's it for this week. Thanks, David.
Take care, everybody.